Generally, when we talk about the type of relief from double taxation, these can be of two types. One, unilateral, and the other one, bilateral. So unilateral is a type of relief which is generally given where the country where the income arises, that is, the source country, has no DTAA with the country of residence. In such a case, if tax is paid in the source state, because there is no treaty in terms of which credit will be allowed, the resident state may, under its domestic tax laws, allow credit for the taxes paid in the state of source against the tax payable in this country on that particular income. However, where a treaty do exist, then a bilateral relief is available under Article 23 of the DTAA, where the country where taxes are paid can provide such a relief. We will discuss mostly about the bilateral relief, but just to understand and complete this particular topic, let's move on to the next slide. So a unilateral relief is arrived or provided in case of income which is accrued outside the state of residence, which is not deemed to accrue or arise in the state of residence. So if a particular income accrues or arises in the state of residence, then in such a case, the state of residence has full right to tax it at full rate, and it is not under an obligation to give any form of tax credit against the tax payable on such income. But if the income has actually accrued outside the state of residence and some taxes have been paid there, then a unilateral relief may be given in cases where there is no treaty between the state where the income arises and the state of residence. Who is eligible for taking the benefit of this particular clause? Any person who qualifies as a tax resident of state R can claim a benefit of this particular unilateral relief. Which country should the income arise? The income should arise with which the country R or the state of residence has a DTAA. Sorry, does not have a DTAA. If they do have a double taxation avoidance agreement, in that particular case, the unilateral relief will not be available. One will be eligible to claim a bilateral tax relief. The manner of payment of tax could be either by way of deduction or otherwise in the state where the income has arisen. And the quantum of relief which will be available will be either the tax which has been deducted in the state of source or the tax payable in the state of R or the state of residence against such income, whichever is lower. So if you pay a tax of $100 and the tax payable here is $200, in such a case, the credit that will be available will be the lower of 200 and tax of 100 will be payable in the state of residence. However, if the tax paid in the state of source is 50 and the tax payable in the state of residence is 40, then the lower of 2, which is 40, is the credit that will be available in the state of residence and no tax will be payable. The excess tax paid here will not generally be allowed to be carried forward to subsequent years in the state of residence. Let's look at the methods through which tax credit is provided. Now, basically, there is one which is called an exemption method. Under exemption method, it can be a full exemption method where, let's say, a person has $100,000 of taxable income. What the state of residence does is, let's say the other taxable income in the state of residence is $50,000 and the exemption limit is, let's say, $75,000. In full exemption method, what the state of residence does is this entire income is considered as exempt from tax and therefore the total income is 50,000. Because this income is below exemption limit, so the tax payable in the state of residence will be 0. However, in some cases, what is done is that there is an exemption, but with progression. What that means is this income is actually considered for the purpose of calculating the total tax. So when you look at the taxable income for the purpose of calculation, you will say, okay, the total income is 100,000 plus 50,000. You will calculate the total tax payable in the state of residence on such 150,000. And then under a prescribed method, you will calculate what is the tax on this particular income and then exempt it accordingly. So even though this income has been considered as exempt, if there is a slab-based taxation, it is considered to arrive at the amount of tax payable. In other words, effectively, what that means is if let's say the slab rates are 10 and 20%. If without this income, the tax rate which was applicable was 10%, but by inclusion of this, the tax rate becomes 20%, the overall tax liability of the taxpayer increases even though this income is considered as exempt from tax. The other one is credit method, which is quite simple. So if let's say, for example, in the state of source, you pay $10,000 of taxes on a particular income. On the same income, the tax payable in the state of residence is, let's say, $20,000. You credit this tax against this tax payable, and the balance tax is what you have to pay to the state of residence as tax payable. If the tax paid is already equal to or more than the amount of tax payable in the state of residence, no further taxation is payable. But if it is less, then the difference has to be paid in the state of residence. Thanks for watching this video on international tax. If you want to enhance your career in international tax and learn everything about how to interpret various articles of a tax treaty, learn about BEPS, global minimum tax, and similar concept, you can subscribe to our online course on international taxation, whose link is given in the description below. If you have queries, you can reach out to us. Look forward to having you on board with us for our course.